Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Ian Walsh. Thanks for being on the show, Ian.
Thank you for having me.
Yeah, Ian is a partner at Hard Money Bankers. He's been there since 2012. He's responsible for underwriting all of the loans in the Eastern Pennsylvania, New Jersey, and Delaware markets as part of his role at Hard Money Bankers. Built and sold Atlas Property Management between 2010 and 2014. So, Ian, thank you again for your time and being on the show. Give the listeners a little more about who you are and what you do in real estate right now, and then let's dive into to what we discussed. I'm going to leave it at that, and then we're going to dive in.
Okay. Yeah, I mean, so the bio is accurate. You know, I came out of school years ago and read Rich Dad, Poor Dad's Robert Kiyosaki book and How to Get Rich. I think Rich Dad, Poor Dad, sorry. And it was, you know, I read that excerpt about wholesaling a deal that he did in Arizona for like 40 grand or something. I thought, what is this? How do I do this? You know, it was a lot of money back then. And I come out of school, I didn't have any money. So entering in the wholesaling way is a good way for entry into a business. I also think it's highly underestimated on how much money you can still make in that business. But nonetheless, that's how I came out in 2008 when the market was crashing. Decided this is a good thing to do and ended up building a pretty large wholesaling company in Philadelphia. So I really learned how to become an investor at that point because I could learn how to source a deal to bring it to real buyers. Because right now we're kind of in a marketplace where like we're closer to a top than a bottom, right? So you have a lot of people that will overpay, and that's not really, you don't really have your huge sharks buying properties right now. So I had to learn how to settle the sharks back then, and they'll come back out again. And, you know, when this thing tops out, but so that was kind of how I cut my teeth initially in the business. And then from there, I grew a property management company. That, as I look back on, you know, it sounds easy on the surface, but easily the hardest part about real estate in general is property management done right. Just the processes and systems and things you have to put in place to do that properly. But
yeah, and some of the most important.
That's right. So I didn't know what I didn't know back then. I started the company, we grew it, really made a very polished company that we ended up selling to a company in Center City. And I was like, what am I going to do now? And, you know, we had decided that I had two silent partners in the management company already, and said, they were deploying a lot of capital in the Maryland area. So we decided, hey, I understand how to underwrite. I understand how the investment area where I'm located. Let's deploy capital in my market. So brought a bunch of money up here. And that's kind of been the story. I've just been deploying a lot of capital on the private front for a while now.
Nice. But you have some skills though now. I mean, you're analyzing lots of projects and you know, just our conversation before we started recording, you know, you mentioned like helping us think like a lender and what that should look like, and, you know, analyzing a project, you know, how a lender would analyze it, and
Sure.
and so we can understand what that should look like. So I'd love for us to dive into that and break that down a little bit. And so, you know, help us to get started though, or maybe where, you know, most people make their mistakes in doing this, but yeah, get us started.
Yeah. So without a doubt, so I always say, don't overthink it, right? Like if people send me spreadsheets and stuff, and I'm like, if you're putting, a lot of times they're overcomplicating a good deal. So it's got to just work on a few fronts typically. So let's just take like an easy example of like a single family flip or something, an investment property that might be a single family flip, or even like a small piece of commercial that's, you know, buy it, fix it, renovate it, and then lease it out. Is that you make your money when you buy. I know that's the oldest saying in this game, but it's the real answer. It breeds you either room for error or profit. But if you buy too high, you have no room for error and you'll make no profit. And a lot of people lose before they even get to that point because they're buying it too high. They don't understand really what a project or a deal looks like in their market, and really where they should be buying, you know, a property at 20 or 30 cents on the ARV dollar versus, you know, the 60 or 70 cents on the dollar that I see a lot of times, because they don't know how to analyze a property to begin with. And that's where a lot of people go wrong, I think. So from a simple numbers perspective or simple like outlook, you've got to buy deep enough. You've got to then make sure your construction or renovation costs, if there are any, which almost all the time there are, to bring that property up to value, are accurate. A lot of times people like to pay too much, put too little in, and then between those two things, there's no profit there. So I see that, and that's really like, if you're going to think like a true private lender, that is what the focus should be: is the asset, where you're buying it, how much you're putting into it, and what's that potential value. Everything in between in terms of like credit, tax returns, all that other stuff. If you're using that, you're really not a true private lender in what you're doing, and you don't really know what the asset's worth. You're trying to actually underwrite the borrower to offset your risk.
So, just, like, don't overcomplicate it. Don't overthink it. It's hard, right? I mean, it's hard not to, want to just analyze it to death and just, make it this big ordeal. But I'd love for you to elaborate a little bit on, thinking about, getting a property cheaper, or maybe the actual steps of a way that you're going to underwrite something to know that we're not overpaying it, because it is when you buy. I mean, the money's made then, and making sure you're not overpaying. And so, what are some tips or things that you use then to make sure you're not overpaying?
So I'd love to tell you that there's a shortcut to this, but there's not. It's screen time. So I'm always in front of my local MLS systems. MLS is your multiple listing services. You can't really do this with the free sites out there. I'm not going to name any because, but you really have to have the data and insight into your local MLS systems. And then it's just constantly, nowadays with technology, you have a map view of, just like Google Maps or whatever. When you bring it up, you can see exactly where the house is, or do the street view. You can do that with, sales data, square footage data, all that kind of stuff. Very quickly, you can identify when, the deal comes in, it may or may not be in a good range, just based on maybe your filtering criteria of however you're answering it. But let's say it's something worth looking at. You should be able to bring that up in your MLS system and know within a minute that, hey, there's something here. Maybe it's not exactly at the right price right now, but this is worth fishing. And then from there, you can basically just in a map view determine extremely quickly, is this area hot? Are properties selling at the right price? Are these only investor pickups? Is there something else here like this? Like sometimes I'll see with like huge commercial, I'll see like a $10 million commercial deal that on paper on the spreadsheet looks fantastic. And maybe if I was underwriting it based on, a lease, like a rent roll, maybe this works. But, that type of underwriting to me is really scary, because if I don't have a comparable sale that I can pull up in a map right away and look at, and I have to deal with a rent roll, it really is saying, okay, the guy operating this thing is really the business owner of this building. And because of that, however he decides to, isn't whatever type of operator he is really what I'm investing in. It's not all the leases in the building. And they certainly help, obviously, to have rent in place. But a bad manager or a bad owner, operating wise, can destroy the inside of a leased building quickly. So what I have to do then is say, as an underwriter or somebody who's looking at a project, okay, what's my potential out value? Well, if I don't have something I can pull up on a map and go, this is the value, then I'm just speculating. And I don't like to speculate as a lender. Like, that's not what I do. I look at the data and go, this is what I have. So it's very important for me, or somebody, they should be able to pull up, look at recent sales, within the last year, call it, of very similar property types. And if they don't have a very comforting, easing, obvious answer right then and there, they're probably in the speculative zone, which they want to remove themselves from if they're, betting their own money on a deal. So
where are you going to find those recent sales?
I find them in my MLSs. So I'll go into my MLS and I go, okay, there's a search criteria. It's pretty easy. And, last 0 to 360 days. And then I'll put a geographic bubble that I'm comfortable with. Typically, it's a lot smaller than people think it is. Like, you can't go, most regions, you can't go miles outside of where you are. You're usually within 1/10 of a mile of where you're trying to buy, to determine where those other properties are. So I'm going to go in my MLS and pull a geographic and time, area that's all similar, and then look for houses or commercial buildings or whatever that I'm looking at that are very similar. And if I don't have any, that means that the value I'm putting on it is guessing, is what that is. And I don't feel comfortable guessing.
I couldn't agree more. You can't guess in this game.
Mm-hmm.
That's for sure. And so, but where can you share where you're getting some of this data? Because the data is so important, right? And then we're going to make our best decision based on this data. But where, I know a lot of people are saying, well, where do you find the best data?
So the data I have is all just from our multiple listing services. Fortunately, I'm in a market that has, like, from what I can see or have seen, an exceptional multiple listing service that it's very user friendly. When I say that, compared to the other ones I've seen, there's about, maybe like 9 or 10 in my local market. There's that I essentially am part of. Easily there's two that are the biggest, and then one that is, fortunately in my market, the biggest that I deal with is also the most user friendly. If you had to like put yourself in a position, I mean, you can have different outlines and different ways to display something, but ultimately it needs to be visual. I find it needs to be visual, and easy to hover over and move around very quickly. So if you're in an MLS system that's like archaic in its data, or the way it displays, like if it only displays in maybe a list of properties and you can't visually see it on a map, that kind of stuff makes picking a value out difficult. So, mine's very user friendly, and I'm very appreciative of being in that. So I would say if people are looking, first thing, do yourself a favor and get comfortable with your MLS system locally. Every area will have their own MLS system that they,
Sure.
Yeah.
So help us to think like a lender. What should we be thinking about, and what does that need to look like, or maybe ways that we don't even know, we wouldn't even know things that they're thinking of.
So a lender, a private lender, I can't speak from a bank's perspective, because if you go to a bank, nothing wrong with banks. Banks are fantastic, but usually when you go to a bank, you're being underwritten as a borrower. So the bank is really, we're all asking, how much are we risking? We're all saying risk, risk. That's all we're concerned with. We're not concerned with profit. We're concerned with risk. So minimizing risk is what our game is about. So you go to a bank, they're going to offset their risk with you being a borrower, or what your skill set is in terms of credit score, tax returns, all that kind of stuff. They don't really know much about the asset. True private lenders are going to be focused on the asset. So the way as a lender, if you want to think like a lender, and I really feel like flippers should think this way, commercial guys that are, retail commercial guys should think this way, because if you think this way first, it's all gravy for you. If you think then, what the upside is. So I'm always thinking, how much can I lose? Like if you die tomorrow, you buy my deal, you die tomorrow, where am I? And then 30 days in, if I give you construction money and you botch it all up, or you just fly to the Bahamas and disappear, where am I? Constantly thinking throughout the entire project, from day 1 to day 90 to, to close essentially, or till it closes out. Where are we in terms of, how exposed am I on this project, assuming that you do nothing right? Now I have some fantastic clients that are exceptional executors of what they do, and there's never an issue. But, they, from if you're on the other side of this, you should be thinking, okay, if tomorrow my entire, if I'm flipping the house, let's just say, if my entire crew leaves me, how much is that going to set me back in holding costs tomorrow? If everybody leaves, my number one crew, boom, guy gets arrested, goes to jail, contractors, happens, right? So if that happens tomorrow, where am I? Okay, can I afford another $5,000 in holding cost on this project while I find another GC? Is that built in here? Is there a 10 or 15% buffer that I've built in? So if you walk yourself through all the what ifs that can go wrong, because everybody, what I've noticed is that they come in thinking everything is going to go right the entire time. Every contractor is going to get paid the exact right amount that I budgeted. Every wall I open up is going to be, nothing's going to be back there. Every tenant that I lease for is exactly going to be this much money. When the reality is it never goes that clean. So you really want to be buffering all the time, and then go, okay, I do all these worst case scenarios. Am I still left with a good profit at the end? And if you go, yeah, I've checked every box and I can't lose here, you probably then bought it for the right price, and you probably budgeted the right amount. Don't trick yourself to thinking it's going to go smoother than it is.
I like how you say, you want to be buffering all the time. And like, you don't know what's behind those walls. And you say, we say, okay, we're going to renovate this many units, or this is the way it's going to work out. But, there's a heavy rehab we were looking at on a property that was nearly 300 units. And, we expected, obviously massive turnovers, but we were going to vacate a building or two buildings at a time and do massive renovations. But there's times where we were underwriting like a 50% vacancy, just in case. Just in case. We're just planning on two buildings at a time, but we know that there'll be more than that, over the first probably year. And so, yeah, I appreciate that. And also, I thought you could elaborate on how, before we even started recording, I think you were talking about how you're an investor first.
Mm-hmm. Yeah, you want me to go into that? Is what you're asking?
Please.
So yeah, I'm a little different in the lending space. So the lending space is traditionally, probably went to school, got your MBA, you come out, you're not wearing a hoodie, like it's just not how it is. You probably have a tie and a button down and so forth. You're a finance guy. You sit behind a desk and you swing a pen. Not how I'm built, and not how our company is built. So I'm not saying there's anything wrong with that. That's just a different space. It's just less, I don't know. I'm an investor in the way that I believe that true real estate investing doesn't judge by color, background, or anything. It judges by, can you analyze the deal and protect your money? So that is kind of where I came from. So I did a lot of real estate investing prior to becoming a private lender, but in my heart and in like the cloth that I'm made of is, you know, I don't relate as well to a banker, even though people would consider me a banker, as I do other investors. It's just, I speak the language of investing with true real estate investors, rather than caring what your debt to income is or stuff like that is just not relevant to me. So that was why I would be considered an investor first, to what most people would consider maybe a banker first.
So, and there's a few questions before we run out of time, but how do you prepare for a potential downturn?
Yeah. All right. So going back to being a investor, a private lender, the downturn is the ultimate, right? That's the cycle risk. I'm always saying what could go wrong, what could go wrong, what can go wrong. So I'm always like going, okay, the downturn's around the corner. It's around the corner. I guess the things I could look at with that right now are, and I actually do a lot of, I interview people locally in my market, similar to what you do, but that is a question I ask a lot of the bigger players as well, because I like to actually get a pulse and a feel from what they're doing. It's a really good question, especially ones that have been through multiple cycles, because you need to know how they survived it and why they survived it. And, you know, preparing for the downturn, I don't know that it's so much preparing or doing anything different as being aware of it, because, you know, nobody can time it perfectly. The only person that says they timed it perfectly is when they make the movie The Big Short, right? And I look back and go, oh, he was so smart. He was a genius. There's a million other guys predicting other things. It didn't work out. He looks like a genius because that's the one that worked out. And it played out because he put a bunch of money into it. Great. You know, it worked out. I don't wait around kind of, you know, saying, okay, it's here, it's, you know, or it's coming in my head, and then like changing my business along the way. I'm always thinking it's coming. I'm always thinking this doesn't make sense now. 2008, you know, money's flowing. The couple of things we have going, money's flowing too well right now. People have money that shouldn't have money right now, meaning that they think they're smarter than the market. And that's when the market comes and gets you. So we're closer to a top than a bottom. I believe that. So, you know, how do I change, or how do I adapt my business to that? Honestly, I look at it and go, I've been underwriting the same way I have forever. And that means I was close to the bottom of a market when I was underwriting to begin with. And I haven't changed my stipulations or guidelines. I haven't gotten looser. So I'm essentially saying I'm battle tested at the bottom of a market in my mind, and prepared for that again. You know, because it will come. It doesn't get to do what it's continuing to do. And I also don't think it's going to happen in the same way it did last time. I think the scars are too fresh with people from 2008, that they are a little bit too aware in the real estate market so what I don't think will happen is it won't double down against real estate again. Last time the catalyst was real estate itself and the mortgage-backed industry and the derivatives and so forth. It was like tied together. Whereas I think we're going to be looking at a scenario where it's going to be something where the world is connected. It will have to be able to impact the entire world, but it won't be in real estate. It will just affect real estate like it affects the rest of the world, be it like currencies, be it like whatever. You know, it could be something that is just not tied to real estate, because the people in real estate are still a little too scarred to get caught with their pants down again in that same spot.
What's a way that you've recently improved your business that we could apply to ours?
I'd say it never hurts to go back over what you're good at and make sure you're continuing to do that. So a lot of times when you're growing a business, different businesses along the years, there's two things I would suggest to somebody is, one, be very clear about like the departments or the pigeonholes in your business, and make sure everybody else in the business is aware of it. I see a lot with small businesses, especially in real estate, where people wear a lot of hats. That's not a good idea. That makes a business very confusing and not scalable. The second thing I would recommend is to make sure that you're in a position where, you know, if you're doing well, or you're happy with where your business is going, don't lose sight of what got you there to begin with. So it's a good refresher every, I don't know, so many years to go back. And we're kind of doing this right now in our business, just reiterating like why we're good at what we do. And let's not lose sight of that, because if you stray too far from what already made you work, and it's easier said than done, because there's all these new things that come up and fun stuff you can do, but don't lose sight of your core reasons that got you to where you are and the strengths that put you in that position, and then grow upon those strengths, as opposed to trying to fight, you know, and make your weaknesses that much stronger. Like you can hire people that are better at weaknesses than you can if you are naturally good at something. Build on your strengths that have gotten you to this point already.
I like that. And how do you give back?
I give back by doing culmination of things. I do certain things in my personal life that, you know, along every so often certain things strike me from a turkey drive to, several years ago, I ran a marathon for, raise money for a girl that was dying of cancer. So, anything in there in terms of my personal life, business wise, I know what it's like to be in the real estate market and like trying to make your way. I talk to a lot of new investors every day and trying to figure it out and trying to all that kind of stuff. So I usually spend a lot of times, honestly, on making sure daily that I give back to people on like forums or message boards that, where I started on those years ago. And that's how I started to cut my way. And like, maybe that one piece of information I could give to somebody could really help them. And then I selfishly and selflessly, do these kind of presentations where I know, it's good for me, it's good for you in terms of marketing and so forth, but it's also very good because this could be helping somebody. So it's like a win-win for me to say, hey, I'm winning, you're winning. And if this information really could like trigger somebody, and I get calls from these all the time, hey, I saw your video or saw your podcast and I learned this, or I did this. And I'm like, great, that one step closer to where you're trying to go. That feels good for me.
It's awesome. I appreciate you sharing that. And it's so true. I hope the listeners gain a lot from the show and will, most importantly, take some action from it, right? If you just listen and it's kind of like overanalyzing, or overcomplicating it. If you don't actually take some action, though, you're not ever going to be able to improve and get where you're going. But most importantly, right now, tell them how they can get in touch with you and learn more about you.
Sure. Keep it really simple. It's hardmoneybankers.com. Ian. So my first name is just IAN at hardmoneybankers with an S.com. And that's the best way.
Thank you for listening to the Real Estate Syndication Show, brought to you by Life Bridge Capital. Life Bridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. Life Bridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.